The United Nations Department of Economic and Social Affairs currently forecasts world economic growth to decelerate to 2.7%. This slowdown is the result of persistent headwinds, specifically tight credit conditions and ongoing geopolitical instability in key energy-producing regions. Global trade momentum has also moderated, with annual expansion slowing to an estimated 2.2% as major powers renew protectionist policies and tariff barriers. Despite these cooling indicators, capital investment within the United States remains highly active, particularly in the private sector. Major firms are committing record levels of capital to artificial intelligence infrastructure, data centers, and the specialized semiconductors required to run them. This chart compares the data sets. On the left, we see a clear cooling in GDP and trade, while the right shows corporate AI spending accelerating. As foreign demand for manufactured goods softens, these tech investments become the primary pillar supporting equity growth. This creates the macro-tech divergence, a measurable gap between stalling state-level economic indicators and accelerating corporate-level technological investment. The pressure on traditional economic sectors increases as growth slows, even as the technological sector expands to support a larger share of market activity. Systemic economic friction is currently forcing massive capital investments into technology as corporations attempt to compensate for sluggish performance in traditional retail and manufacturing. To manage these mixed indicators, the United States Federal Reserve has maintained the federal funds rate between 3.50% and 3.75%. Officials are cautious. They must balance the revenue generated by massive tech investments against the long-term impact of persistent budget deficits and elevated bond yields. Monetary policy is shifting in Japan as well, marking a departure from years of ultra-loose credit. The Bank of Japan is now permitting domestic sovereign bond yields to rise. This policy shift triggers capital repatriation. As domestic returns in Japan improve, institutional investors are prompted to move their capital out of foreign markets and back home. This massive flow of liquidity quickly moves away from international pools, concentrating back into a single domestic source. This map shows the resulting pressure. As capital leaves North America and Europe, the yields on foreign government debt in those regions begin to rise. This creates a difficult environment for governments already running substantial fiscal deficits, driving public debt levels to record heights across both advanced and developing nations. The combination of capital repatriation and record global debt means that governments are increasingly reliant on high-yield bonds, which permanently raises the baseline cost of borrowing for all market participants. The ongoing flood of government bond issues is currently absorbing a significant portion of available global liquidity. This diagram illustrates the competition. Government borrowing is now vying for the same capital required to fund massive, long-term corporate technology infrastructure. This competition for credit causes real borrowing costs to spike, remaining elevated even as other economic indicators soften. This leads to a crowding out effect. When governments and tech giants consume the majority of available credit, capital becomes too expensive for traditional, lower-margin businesses. High interest rates also force governments to divert public budget allocations away from non-essential infrastructure just to service the interest on their debt. In contrast, major technology firms currently generate enough revenue to absorb these high borrowing costs, allowing their capital spending boom to continue. Because these firms can afford to borrow at high rates, technology infrastructure has become the most consistent driver of growth in advanced economies. This tech-led surge in equity value helps compensate for the weaker consumer demand seen in traditional retail and manufacturing. The concentration of capital in these specialized assets suggests that stock index growth is becoming increasingly detached from broad industrial health and more dependent on the performance of a few highly capitalized technology firms. Beyond financial markets, physical bottlenecks are creating sticky inflation. Geopolitical friction in the Middle East is directly impacting maritime shipping channels. Fluctuating transit costs through the Strait of Hormuz increase the price of energy for importing economies, keeping consumer inflation high. To counter this, energy providers are deploying grid-scale utility battery systems capable of discharging power for up to 8 hours. These systems stabilize regional grids by storing excess solar and wind power during off-peak hours, reducing the reliance on volatile fossil fuel imports. The agricultural sector is adopting similar technological bypasses, specifically through the rollout of advanced biofertilizers. These new biofertilizers utilize beneficial microorganisms to deliver essential nitrogen directly to the plant roots, ensuring crop yields remain consistent. This technology allows producers to bypass traditional nitrogen supply chains while significantly reducing toxic runoff into waterways. As import tariffs rise, multinational corporations are also restructuring their critical supply routes to maintain efficiency. Logistics and financial firms are now using cloud-based quantum processing units to solve complex routing and risk modeling problems that exceed the capabilities of traditional computers. These physical technology deployments operate as urgent, capital-intensive bypasses, protecting productivity from the impact of broken supply chains and volatile energy markets. Within the European Union, annual growth projections have been revised down to 1.3%, as demand for manufactured exports continues to soften. To maintain margins in a slow-growth environment, tech firms are transitioning to autonomous software agents capable of executing multi-step business procedures with minimal oversight. These tools automate complex tasks like market research, code updates, and logistics planning, reducing the need for human intervention. Generative AI has also reached technical maturity in video creation, allowing firms to produce photorealistic synthetic footage and replacing traditional media production pipelines. Additionally, corporations are replacing traditional passwords with decentralized biometric authentication systems to reduce identity theft and management overhead. In the transportation sector, robotaxi networks are expanding in metropolitan areas, using edge computing to lower accident rates compared to human drivers. Consumer technology is expanding through multimodal smart glasses, which capture real-time visual context to provide navigation and instant voice translation. Telecommunications giants Docomo and Samsung have validated AI radio access network technology to support these data loads, enabling 6G networks to dynamically alter settings for individual devices. This bypass of traditional constraints even extends to clinical trials of brain-computer interfaces, which allow paralyzed individuals to operate digital systems using thought alone. Software and automation are functioning as structural deflationary tools, allowing corporations to maintain profit margins despite stagnant consumer demand. This tech-heavy strategy contrasts with the model seen in India, where GDP growth is projected at 6.6%. India's growth is driven by solid domestic consumer spending and sustained public infrastructure investments, which provide a shield against global market volatility. However, from a global perspective, the data indicates that the era of inexpensive capital has ended. This structural model shows how costly capital is concentrating strictly in tech assets, like AI and advanced batteries, that offer high-dimensional productivity multipliers. This hyper-concentration of capital into technology successfully bolsters stock indexes, masking the ongoing vulnerabilities in traditional retail and manufacturing sectors. We are witnessing a global bifurcation, a split between economies and corporations running on next-generation technology and those remaining on traditional models. This sharp division in overall infrastructure strategy permanently separates global market participants, aggressively moving them towards two entirely distinct operational trajectories. Entities that successfully deploy autonomous, optimized systems will decouple their productivity from macroeconomic headwinds, while those reliant on cheap debt and traditional trade will face stagnation.